One of the things people despise the most. Hey everyone, it's Zach here, and today I want to talk about taxes. As they say, there are only two things in this life that are guaranteed, and that's death and taxes. But what I want to talk to you about today are those tax loopholes. So before I dive in, it would be super helpful if you could just mash that like button down below and subscribe so that you don't miss out on any future tips. If you didn't know, I go by the Money Nutritionist because it's my job and duty to help provide you with useful financial information that is healthy. There is a difference between healthy and non-healthy financial tips. Think of healthy tips like vegetables and non-healthy financial tips like a bag of potato chips. Yeah, you can day trade and it tastes great. But is it really that healthy? Or you can make super risky investments that may feel great if you hit big, but is that really healthy? The tax loopholes I want to talk to you about today are super healthy. Make sure to watch till point number 5 because I saved the best for last. Now that you've smashed the like button, let's go ahead and dive in.
Let's get it on!
The government loves to take your money, and they do that through taxes. If you want to know more about taxes, check out season 2 of True Freedom, episode 1. And it goes into a full deep dive of taxes and why we have them. And I'll put the link down in the description below. When you make money, that money is taxed. And the taxes go to the government to be used for different things. Depending on how you earn your money will determine your tax rate. Some things are taxed higher than other things. Take for instance the first tax loophole, which is the capital gains tax. The capital gains tax rate is 15%. Capital gains are taxes on investments that are held for a long period of time, usually longer than a year. Since the tax rate is 15%, let's say you make $1,000 over 2 years. Then your tax rate of 15% would mean you would owe $150 in taxes. Now let's say you earned that same $1,000 by working your regular job. If your tax bracket is 25% based on your yearly income, then you would actually have to pay $250 on the money you earned by working versus making an investment and holding it for a long period of time where your tax rate would only be 15%. So that's a $100 difference on only $1,000. So imagine a house or imagine something extremely valuable. The capital gains tax rate can save you a ton of money. This is why wealthy people really try to use the capital gains tax rate and not have things taxed at their normal rate for earned income. The most common investments that you'll probably encounter for capital gains taxes will be stocks and real estate. And since we're talking about real estate, let's go to loophole number 2, which is the mortgage interest deduction. Pretty much every single person with a mortgage is paying an interest rate. On average, those interest rates will range from 4% up to 8%. The great thing about owning a home is the interest you pay on that home is actually a deduction on your taxes. The mortgage interest deduction is really more helpful for wealthier people with larger homes, but just recently mortgage interest deductions are capped at $750,000 for the value of your home. But for the majority of us, you can still use this deduction to take a few $100s off of your tax bill when it comes around next year. This is if you own real estate. So you can see so far that with point number 1 being capital gains taxes and point number 2 being mortgage interest deductions, that it's really helpful for you to start investing. Real estate so far seems to be the best place for you to find tax loopholes. Let's see what other loopholes we can find. The third easy loophole that you can use is to invest into an IRA account or into an HSA account. This would be a traditional investment retirement account or a health savings account. When you contribute to either an IRA or an HSA, you can deduct some of that money from your taxes. There are limits on how much you can put into an IRA and into an HSA, but it's great because that will still limit how much you have to pay in taxes. Isn't it crazy that you can invest into an IRA, which allows that money to grow tax deferred until you retire, and while you're doing that, you can slowly be reducing the amount of earned income that you made during the year. And on the flip side, the HSA, you're doing the same thing, except the earnings that you make are also tax-free. So you're putting money into an HSA where you're using that money for medical expenses, but if you earn anything by investing that money, what you earn is tax-free, assuming that you use the money for medical reasons. But if you plan on having kids going to the hospital, most likely you're going to eventually need that money. Both of these are great things to have, and it's a great way to utilize a tax loophole. Now it's time to get a little more advanced.
Alrighty then.
Loophole number 4 would be the 529 tax credit. So a 529 is a savings plan for education. If you do want to know more about 529 plans, IRAs, or HSAs, I do have a playlist for the Minute of Nutrition where I take less than 2 minutes to discuss all of these topics. So if you need to refresh, go watch those videos. Now the 529 tax credit is where certain states allow you to deduct the amount you invest into a 529 plan from your earned income. There are only about 30 states that do give you some sort of tax credit. So you need to check with your specific state to see if there are any benefits for you. I know in my state of North Carolina, we don't get a 529 tax credit. There also is not a federal 529 tax credit. It's only at the state level. But if your state has one, here's the fantastic thing. Let's assume you have your kid going to a private grade school or to college. What the 529 plan would let you do is you could take money, put it into the 529 plan, take it right out of the 529 plan, pay for education expenses, and then take the tax credit on top of that. It's crazy, and I think that might be why a lot of states got rid of it, but as I said, a lot of states still have that tax credit. So definitely check, and if so, this is a great tax loophole for you to use. Now we have finally reached the last, final, easy loophole that you can start today. The fifth and probably the best loophole that you can use is by starting a business. A home business, to be more specific. Starting a business comes with tons of tax loopholes. Just look at all the corporations that don't pay any taxes. Not only does starting a home business give you another revenue stream, but it allows you to deduct money from your earned income for the year. And it's usually deductions for things you already use. Let's take an example. You decide to start a home business for tax purposes and because you want to make a little extra cash. First, you need to decide how you want to structure your business. You can be a sole proprietor, start an LLC, an S Corp. I would do your research on how you want your business structured. But once you do decide, it's only a couple $100s to start your business entity. For example, here in North Carolina, it'll cost you about $250 to submit your paperwork to the state to start an LLC. Then you can go file a DBA, which just means you're doing business as a certain name. That might cost you 20 to 30 bucks. And heck, you don't even need a website, but those are cheap nowadays too. So for a couple $100, you can easily start a business. The list of home business options you have at your disposal is endless. You can be a freelancer for just about anything, or you can just be a consultant for also just about anything. Or if you're great outside, you can do carpentry work, you can do pressure washing, cut people's lawns, whatever that might be, you can start a home business and it's not that expensive to do. So let's say you've started your home business and you actually make some money during the year, right? The other thing is that you have deductions as well. Now, since you have a home business, you most likely will need a home office or some space where you do your work. Let's say that you take up 15% of your house for a whole room that you have in order to have your home office. That means if your office takes up 15% of your home, you can also deduct 15% of your heating bill, 15% of your water bill, 15% of your internet bill, 15% of your electric bill. And just think of how much you're saving on things you already use just because you have a home business. By having a business, you also get to deduct a ton of other things that you use. For instance, travel for business purposes, your phone, mileage, and anything that you buy for your business, like pens, pencils, paper, laptops, computer screens. All those things you're buying for your business that you may have bought for yourself anyway become deductions. So think of all the things that you would be saving money on that you're buying anyway. And then on the flip side, you have a business that you need to run, which means you need to make money. So you're making money and you're saving money on taxes. It's a win-win situation. But if you're not the type of person who sees themselves as being an entrepreneur, then I completely understand. You still have 4 other tax loopholes that you can use. So just to recap, the 5 tax loopholes that are pretty easy and you can really start them today are the capital gains tax rate of 15% for investments held long term, the mortgage interest deduction for interest that you pay on any mortgage for real estate that you own. Investing into an IRA or an HSA, these will lower your earned income for the year, meaning you'll pay less in taxes. The 529 tax credit, which you need to check your state to make sure you have a tax credit for the 529 plan in your state. And if you don't, it's still a useful account to use. But if you do, you can pay for your kids' private school or for college, so that will give you another set of savings. And last but not least, but starting a home business, which allows you to, first of all, make some money and be an entrepreneur if that's your thing. You can also deduct a percentage from bills you already pay based on the percentage of the home you use for your home office, and you're deducting materials and supplies that you're buying for your business, which some of them may be things you're using already or things that you need. So what I want you to take away is the fact that these loopholes aren't things that are illegal. These loopholes aren't you exploiting the system. And in honesty, these loopholes are things that can help you not only for retirement, but right now. A 529 plan helps your kids go to college. An IRA will help you with your retirement, for Christ's sake. Starting a business can make you rich. So I mean, you can call them loopholes, I call them loopholes, but at the end of the day, they're great financial tools that can make your life better and your family's life better. So I recommend you doing your own research, seeing if these things fit your lifestyle, and if so, go start them today. Because if you don't start today, in the next years, you'll be saying to yourself, dang, I should have started doing that years ago. As always, if you have any questions, make sure to leave them down in the comments. Don't forget to subscribe and hit that like button, and I'll see you guys in the next video. Thanks for watching. Be sure to follow me on Twitter, Instagram, and Facebook to stay updated on the latest. But more importantly, to stay updated on YouTube, press the subscribe button below.